and running on YouTube in just a couple of seconds. If you just give it a second. Sweet. We are officially live on Facebook and YouTube. So let me first of all kick off with a first huge welcome and congratulations. This is episode number 6 of the Katana Property Channel. Today we've actually got a really exciting topic, or a really exciting subject, which is all around leverage. So how you can get the most value from building your portfolio. So let me first of all kick off with saying thank you very much for attending today. Thank you very much for taking the time out and watching this. So if you're watching this and recording, thank you very much for watching. Please give us a like, please give us a share. We want to try and grow this channel as much as possible. And secondly, and much more importantly, what you should do is you should commend yourself for doing what 99% of the world refuses to do, and actually taking your time to invest your time in educating yourself and learning how to be able to build a portfolio effectively and strongly. Colin, awesome to see you, buddy. Long time. We haven't seen each other for a long time, man. Very cool to hear to see your name. Actually, I saw a friend's request from you recently. So yeah, super cool. Awesome to see you. And also, Gavin, very cool to have you on as well. Thank you very much for joining in. It doesn't seem like I've got any of the comments showing up on YouTube. So if you're on YouTube, I know we've got a few people viewing. Just please give us a message or a like or something, just to make sure that that's working fine. Okay. Cool. So like I say, it's a really exciting session. I'm actually very much looking forward to this. We've literally just run a 3-day training this last weekend just gone. And part of what we covered over the weekend is a lot about leverage, a lot about how you can build your portfolio, and a lot about how you can maximize your original investment pot to getting much more portfolio than you thought was possible. But without further ado, essentially, there's 2 main core subjects we're going to be covering today. For those of you that this is the first time that you're tuning in, please feel free to hit the subscribe, the like, join the pages, Katana Property Channel group or the Katana Group Limited page. We'll be doing loads of these. We're doing one of these every single week, and then we're also doing some live updates on Thursdays, kicking off very soon. So the 2 core subjects we're covering is one about lending. So this is all about how you can leverage the bank to maximize the amount of money you have. And the second one is all about equity release. So this is how you can release equity within your existing portfolio or your existing house to be able to create a much larger portfolio, much larger income, much larger equity value. And it's really interesting because a lot of you will be sitting there watching this right now, and you'll be in a position where you are literally sleeping in the thing that will make you financially free and prevent you from ever having to work another day in your life. So very exciting session. I'm very much looking forward to it. And hopefully you guys are too. Hopefully you get tons and tons of value of where we're at. Okay, so once we've done those 2 sections, obviously there's loads of subsections within that. Once we've done those 2 sections, I'm going to open the floor up to a Q&A. Q&A is ask whatever questions you want. We typically run this till about 9 o'clock, so you've got time. If you have questions throughout, I love to have an open dialogue, a good conversation. So please feel free to drop a message into the chat at any time, and I'm more than happy to answer any question. Please bear in mind there's about a 15-20 second delay before stuff actually takes hold. Hey, Paul, awesome to have you on as well, buddy. Long time no see. So obviously saw you this weekend, so very cool to have you on, man. Right, so without further ado, let me actually get you guys kicked off. So obviously when it comes to building your portfolio, we always suggest that you leverage. So, you buy and you get the bank to put in some of the money to help you build your portfolio. It's fascinating you guys know each other. So to be able to do that, you've got to understand that there's multiple different types of mortgages available to you, or lending options available to you. But in terms of the mortgage options, primarily there's 2 core options of mortgage. Now, if you know what those are, please make sure you drop it in the chat, and let's just see where you guys are at. Please bear in mind that there is a long delay, so your message takes a while before it gets in. But there's 2 different types of mortgages, 2 core types of mortgage. So the first one, awesome to have you, Paul. So the first one is what we call an interest-only mortgage. So this is where on a monthly basis, all you are busy paying is the interest. The value of the mortgage does not go down through time. It stays exactly the same as your 80, 100, 90, whatever the thousand it is. It stays the same, but you're paying the interest every single month. Okay, the second type of mortgage is something called a capital and interest repayment. Hey, Cookie. Well, mate, long time no see, buddy. Awesome to have you on the stream. Super cool, dude. Thank you for joining. I hope you enjoy it, and hope you guys are doing amazing, by the way. So then the second type of mortgage is what we call a capital and interest repayment. So this is where you are not just paying the interest every month on your mortgage, but you're also paying down the debt month on month, year on year, until there's no more mortgage outstanding, and therefore the cost goes down. Now, we always suggest, and this is my preference, and I will explain why as we go through the session. Everything will make sense. We always suggest use interest only. Let me explain why. Okay, but before I do, let's talk a little bit about buying a house in cash and buying a house in a mortgage. So a lot of people think that buying a house for cash is a better use of your money, and it's a very, very common belief. So let me show you why buying for a mortgage tends to get you better returns if I can. So just want to check in. Can you guys all see the flip chart okay, all the way down to the bottom, which is all the way down here? Just want to check in because if you can't, then I have to look at how I do this slightly differently or move the camera. So do respond in the chat because I will be looking up and I will be editing. By the way, while I'm looking down, I'm watching the chat, just so you know. Okay, so buying cash versus mortgage. So let's just say you have 100K savings. Okay, that's what you start with. Okay, so you have 100K savings stashed away in the bank. And you find a beautiful house and you go, look, that makes a wonderful investment property. Okay, and the house costs 100K. Now, simple math dictates, okay, and I'm sure you'll agree, buying a house, if it's going to cost you 100K, now this is all in, please understand, I always like to go through the concepts because we do not have time to go through the granular information in these sessions. On the 3-day sessions, we go a little bit more granular so you can start to understand things at a much deeper level. Within our mentorship programs, that's where we really dive in so you know everything inside and out. But for the interim, 100K will, if you've got 100K in savings, the house costs you 100K. That's it, you can buy one house. Now, as a fact of history, within the UK, we're very fortunate to be able to say property prices, as an average, double in value every 8 to 10 years, as an average. Now, some of you may agree, some of you may not agree, and that's okay. You're allowed to disagree. I would urge you to look at the Office of National Statistics property prices over the last, since records began, and you'll see they have doubled on average every 8 to 10 years. And to prove the point, ask anyone you know who owned a house, who bought a house in like 40 years ago, what the house was then and what it's worth now, and immediately you'll know it's true, it works. Okay, but let's just say, as per standard, in 10 years' time, this property has doubled in value. Okay, so it's gone up from 100K and it's now worth 200K. Okay, nice and simple. Okay, nice, easy math. And then let's say another 10 years pass. Okay, now the house is worth 400K. Okay, so you're 20 years down the line now. Now, if you were to sell this house 20 years down the line, okay, if you sell the house 20 years down the line, okay, minus your original investment, okay, how much profit are you going to be standing to make at this point? Okay, how much profit will you stand to make at this point? Okay, and it's very simple. So you got your 400,000 minus your 100,000 original investment. Okay, this is obviously pre-tax profit. Okay, the whole idea is concept. Okay, so you make 300K within 20 years without having to do anything other than buying a property. Okay, nice and simple. All you've done is buy a house and you make 300,000. Would it be okay if I show you how to make significantly more, though? Let me just check in. And please keep the chats coming in, guys. Awesome to have you guys on. Thank you for joining, Walter. Yes, I am in the studio, Taro. Can you not tell? It's a wonderful studio. It works an absolute treat. But yeah, awesome for you to join us, Taro. It's super cool. So Taro is obviously my business partner. He's based up in Manchester. He was down with me this last weekend as we presented, and now he's on for this session as well. So very cool. Well done. Barnes, check you out, buddy. Welcome for joining. I hope you enjoy it, man. I hope you enjoy. So yeah, so if you buy a house, obviously 20 years down the line, doubles in value every 8 to 10 years. You then sell it off. You make yourself nice 300K. I will tell you how to make more, man. Don't worry. Okay. Now, exactly the same premise. So you start with exactly the same 100K in savings. Okay, exactly the same 100K. You find exactly the same 100K house. Okay, no difference. The difference is this time. Hey, Clive, welcome. Thanks for joining, buddy. Awesome to have you on, man. So purchase price in this house is 100K, right? Nice and simple. However, this time you buy it based on a mortgage. Cheers, Barnes. Okay. So you're funny, man. So basically on a mortgage, the bank will typically lend you on a mortgage 75% of the value of the house. Okay, so that equates obviously to 75K. Okay, and obviously your deposit at this point is 25K. Now, if you only have to put in 25K to buy one house and you've got 100K savings, obviously that means you can buy 4 houses, which means you've got 4 mortgages, 4 houses, 4 mortgages, and 4 deposits. Okay, which equals to a 400K portfolio, 300K in mortgages, and 100K in deposits. Okay, nice and simple, easy math. Love it, Colin. So easy math, nice and simple. Now, of course, 10 years down the line, okay, these property prices, it would go up to 800K. Your mortgages, obviously, it stays the same because it's interest only. Okay, so you end up still with 300K. And of course, your 100K is still 100K. Now you move another 10 years down the line. So obviously, you're down 20 years. Okay, 800K becomes 1.6 million. 300K stays as 300K. And your original 100K stays as 100K. Can you still see that on the camera, by the way? Just want to check in. Okay. Now, if you were to sell the portfolio at this point, okay, if you were to sell the portfolio at this point, 20 years down the line, having bought on mortgages, so you could buy 4 houses, that means it would be 1.6 million minus 400,000, which means you'd be making 1.2 million pound gross profit, pre-tax profit, as opposed to making 300K. Okay, who would prefer to make 1.2 million instead of 300,000 using exactly the same starting pot of money? Let me just check in with you guys. Who'd be okay with that? Okay, who'd be okay to make 1.2 million instead of 300,000 using exactly the same lump of money? Just sort of want to check in. Please make sure you stick in the comments and post in because it sort of keeps us active and keeps things moving. For those of you that have just joined, please make sure you like and share the videos. Feel free to subscribe to the YouTube channel. We got that running on. Awesome. Thank you, guys. And on the Facebook, please make sure you join the Facebook groups. Give us a like, give us a share. Let's keep this feed and this stream growing. Okay. So essentially, the only thing that you've done differently, okay, is to leverage the bank's money. Now, you might go, yeah, but the bank's money is going to cost me money and I'm going to have all this debt and all of this fun stuff. Let me show you why you don't need to worry about that, okay? Because you're starting off with the value of the property is 100K, okay? The mortgage of the property is 75K, okay? That's it, nice and simple. So this is when you're buying a property, starts with 100K and the mortgage is 75K. Now, 10 years down the line, the very same house is worth 200K. The mortgage is still worth 75K. Another 10 years down the line, now the house is worth 400K. The mortgage is still worth 75K. Now, this is where it starts to get really interesting. Okay, and this is for those of you that aren't 100% sure with this stuff. This is where it starts to go, okay, now I get why property investing is always a winner long term. Because the value or the percentage debt you have at this point, is 75%, right? Okay, everyone's happy with that. So 75% of the value of the house is owned by the bank in debt. Okay, because their mortgage is 75%. Now, 10 years down the line, the value of your debt has halved to 37.5%. Interesting, right? Because you haven't been paying down the mortgage. The mortgage value stayed the same. The interest is what's being paid. And the beauty is the interest is what's being paid by the tenant. It's not being paid by you, it's being paid by the tenant and leaving you some money left over every single month. Now we take that another 10 years. The value of your debt is 18.75%. So again, it is halved. And then again, it will half again and half again year or 10 year on 10 year as an average across the UK. Now it's interesting because the value of your debt is going down, which means by definition, the value of your debt is being paid off. Who's paying it off? Okay, and that's the real question, like who's paying it off? Because right now, your money in the bank, you're getting 0.nothing in terms of interest in return, but your current rate of inflation means that your money is depreciating in value month on month, which means it's costing you money every single day that your money is in the bank. Whereas if you put it in the portfolio, the very same inflation, instead of devaluing your money, is devaluing the bank's money. Okay? And it's doing that because the value of £75,000 is going down through time. To prove that point, if you think of what happens with bread and milk and eggs and cheese and all that stuff, year on year, it's going up 8, 10, 12% every single year in value, which means on average, every 10 years, they've pretty much doubled in value. Property does exactly the same. It's not because those items have gone up in value, because the pound has gone down in value. Okay. Now it's interesting because I know some of you guys are going, okay, that's all well and good. So now I can see my portfolio, the mortgages are being paid off through time on their own. And at some point, 30, 40 years down the line, this 75K is going to be small enough that you can drop it on a credit card. As an example, people in the 50s and 60s were buying houses for £5,000, £6,000, £7,000. You can drop that on a credit card right now, comfortably. As a matter of fact, many of you can, that's a month's salary for some of you. Okay. And exactly the same way, this will also become a very small amount of money through time. However, the value of your portfolio continues to maintain its value, and therefore the value of your money continues to maintain its value. And this doesn't even include the income you get from your portfolio, which is where it gets a little bit more interesting. Okay, so let's take this to the next level, because I know some of you guys are going, okay, but if I buy the house for cash, I'm going to earn more cash flow, right? I'm going to have more income month on month. So let's look at those numbers. So let's just say you have £600 a month. Okay, and this is your rent. Okay, so let's just say for this individual £100,000 house, you get £600 a month's rent. Okay, then you've got your management fee, which is your lettings fee. Okay, that's typically 10%, which is £60. Okay, and then you've got your maintenance and insurance and voids and all of those other costs, what we term your operating expenses, your monthly operating expenses. The term is MO, monthly operating expenses. This also equates to around 10%. Okay, nice and simple, which again equates to £60. So at this point you go, okay, yeah, but I'm making £480 a month net cash flow from this house. And if I get a mortgage, there's no way I'm going to earn that. You're wrong. Let me show you why you're wrong. Okay, because for the very same rent, so £600 a month rent, okay, then you got your management, your MO, and your mortgage. Okay, obviously this is your 10%, same again, 10%, same again. And I'll go through the mortgage calculation with you in a second, but this is 60, this is 60. Okay, now your mortgage costs, if you do, let's do a 3% mortgage, which is totally achievable with the typical buy-to-let property. If you're a new time landlord, then after a year, you can comfortably get these kinds of rates. So 3% mortgage. Feel free to do this online, but essentially the calculation is you have your mortgage amount, which on the house was 100,000 house, times the loan to value, so the amount the bank lends you, which is 75,000, times by the annual interest, which is 3%, okay, which I think is 2,250, okay, and then you divide that by 12 to give you your monthly mortgage cost, which is £187.50. For this exercise, I'm just going to do 187 because I don't want you to be lost in the numbers. Okay, now watch. So of course you got your 480 minus that, okay, which is 293. Okay, this is your cash flow. And you go, yeah, but that is less. The difference is you have 4 houses. Okay, you got 4 of these. You don't just have 2 of these, you got 4 of these. So that means, okay, your cash flow is, what's that? That's, so 586 times 2 to 1,000 and 1,172. I believe that's right. Now, again, just by leveraging the bank, you've got your income up from £480 a month up to 1,172. Okay, now I'm going to take this to the next level again for you, so you can start to understand why we build a portfolio in the way that we do and why we leverage. Okay, so let me first of all start with what a typical deal would look like. So a typical investment deal, okay, you'd be buying for purchase price for about 60K. Okay, now we've done this in some of our previous sessions. I urge you go tune into some of these sessions. Let me just check in. Are you guys getting some pretty cool value from this and pretty cool information already, and hopefully blowing some of your minds? Because this stuff is amazing. Like, property blows me away. When you understand how it works, you get why people do it. Okay, it's the best investment class in the world without doubt. Okay, so typical purchase price of 60 with a refurb of, let's just say, 20K and you've got some other costs, so lending, stamp duty, all that stuff for 5K. So you're all in for 85K. Now, of course, you've done a big refurbishment because you bought a house for a good discount. Yes, you're more than welcome to swear, Barnes. Crack on, buddy. I swear more than enough for both of us. You're all good, mate. Okay? But you're all in for 85K. And, of course, you bought a house for a 20K, with a 20K refurb because you bought it for a discount. Okay? At this point, okay, I'm now curious to see what some of the responses are. Okay? At this point, now you go and get the bank to revalue the house. And then I'll go take a look at the house. They say, you've done a good job. The refurbishment's sound. We expect the property's worth 100,000. And they tend to lend you 75% of that, which is 75,000. Okay? Which means they lend you 75,000. You've invested 85,000. So technically, you've got 10K invested in this house. Okay? This is your standard deal. Technically, you've got 10,000 invested in this house. Okay. Now, the interesting thing is 100,000 minus 75,000 means you have a 25K equity. And this is where it gets interesting because you've invested 10,000, you've got 25,000's worth of equity. Fuck yeah, good value. Good, man. So, so you've basically more than doubled your money in terms of equity as well as bought a property that will give you an income for the rest of your life. Okay, now let me start to make this a little bit more interesting. So let's just say the typical deal, okay, so this term here, so the money you've got invested here, and I know I'm going at a very fast pace, and I know some of you go, I have no fucking clue what you're saying. Please just watch it again as many times as you need to, and I guarantee it'll sink in, and as soon as it does, you'll sit there and go, holy shit. Okay, and sorry for swearing, it's what I do, engineer, rugby player, etc. Okay, so that term is your money left in. That's the money you've got invested. A typical buy-to-let. Okay, typical buy-to-let in the north of England, if done correctly, done with the right systems and the right team, this is what we do. This is how we teach you on the 3-day training. Okay, typical buy-to-let will give you, give or take, 15K money left in. Okay, and give or take 25K equity. Okay, so this is a typical deal, nice and simple. Okay. So you got about 15,000 invested, you got 25,000 worth of equity, and you've also got 250 per calendar month cash flow. So that's your income after all expenses. Okay, so these are your basic figures. Now what I'm going to do is I'm going to show you how those of you that have any equity, who's got some equity at all in your house, and a little or a lot, doesn't matter who's got some equity in your house, just give us a yes in the chat box. Although yes, the whole world gets to see it, but it'll be cool. Trust me. You'll understand why I'm asking you to do that in a second, because in a second you're going to go, holy shimoly, that's ridiculous. Okay, so this is our basic figures. Typical buy-to-let. Have about £15,000 invested after refurbishment, refinance. Okay, a typical equity position at that point will be 25,000, and your cash flow will be somewhere around 250. Okay, now let's just say you have an equity position of 150K that you can remove from your house and utilize for whatever you need. Just as an example. Now, you can do this exercise however you want to do it based on your own personal circumstances. Okay? Nice and simple. Okay? Now, a typical deal leaves £15,000 invested. So what we do is we go 150K in equity, divided that by the 15K money left in, which means you could end up buying 10 houses. Okay, with that money. You end up with a portfolio of 10 properties. Good lad, Barnes, good lad. This is why I'm here. Okay, you end up with 10 houses. Now, bear in mind, those 10 houses will end up having 25K's worth of equity, give or take. Okay, 25K equity. So you times that, which means your 150K has now become 250K in equity. Okay, so you've won. Okay, immediately you've made money. Okay, nice and simple. You built this portfolio, you've made money. But this isn't the bit that really grabs you, because 10 houses times 250 per calendar month equates to £2,500 cash flow per month. So that's another 2.5 grand that you never have to work for ever again in your entire life. Now, I know some of you go, yeah, but that 150,000 has just cost us money because we're having to pay the mortgage lender for borrowing that money. And you're right, you're 100% correct. Okay, so remember that figure, so 2,500. So let's just say your 150,000 costs you, I don't know, 5% a year. Capital and interest repayment, that's what you have to pay, 5%, which is a lot, just so you know. You should be somewhere around 2, 3, 4. Okay, but 5%. Okay, which equates to 7,500. Divide that by 12. Kev, you got your calculator? 7,500 divided by 12. So Kevin's the sound man in the back who's doing an amazing job. If you beat him to it, I'll be impressed. You guys get cracking. Okay. Okay, so that'll cost you 625 a month. So that's the cost of your money. Okay, it's the cost of your finance. It's pretty expensive. Okay, 625 for that. It's pretty expensive. Now, you're earning 2,500 a month. Okay, then you minus your 625. Okay, equals a net cash flow of 1,875. Net cash flow. That's after paying your lender. That's after everything. And in turn for doing that, not only, okay, I'm burning through the paper. Tara's going to be weeping right now as he watches this. Okay, not only have you got 1,875 cash flow, okay, you also have 250K equity, which, by the way, is 100K gain for your efforts. Okay. Interesting, right? Now, all you have to do to figure this out is however much equity you've got, and I mean however much equity you've got. Okay, so for those of you at home, this forms part of your exercise as well, but it's useful for you to do. So whatever you do is you go your equity, okay, divided by 15K. Okay, that equals the number of houses you can buy. Okay, and then you go houses times by 25K. That equals the amount of equity you will end up with. Okay, and then you go equity. So this is where it gets a little bit more complicated. Times your, I suppose, repayment. Percentage. Divide by 12 equals your mortgage cost. And then you do your houses times by 250 minus more cost is equals to your cash flow. Okay, nice and simple. Okay, the tricky one is you figuring out how much your mortgage is going to cost you every single month. That's the trickiest bit that you've got to figure out. But when you know that, you can actually see how much money you're going to be making extra on top of the money you've got. Okay, so please bear in mind, this money, this cash flow, you do not have to work for. You do not have to get out of bed for. You do not even have to pick up the phone for. You can lie on a beach in Barbados with no phone, no mobile, no laptop, no nothing, earning this money. Okay, it's just a fact. It's what it is. Now, there's things that you have to do and put in place to make that happen, but you can make that happen. It's what we do. And on top of that, you've also increased your family's wealth significantly. Now, let me show you how this gets a little bit more fascinating. Who's okay if I take this to the next level and sit there and make you go, my mind is beyond blown. I've just decided that I'm buying property for the rest of my life. Who'd be okay with me doing that, by the way? Okay, it could take a while to get 10 houses, though. Could really put a strain on life if having to find an extra 625 a month. Yes, John, you get something called a flexible option mortgage. Okay, or basically you can use your house like a credit card. And only when you use the money do you pay the interest on it. So that 625 is only payable when you've actually used all of the money. Really good question. Hopefully that answers it, but really good. Okay, so let me show you how to take this to the next level. Because now, okay, now you have 10 houses. Okay, you have 10 of them. And bear in mind, each of these houses is worth approximately 100,000. If you've got an equity position of 25,000, each house is approximately 100,000. Okay? Which means the value of your portfolio at this point is 1 million. Nice and simple. Okay, then the value of your mortgage debt at this point, okay, and this is where it gets a little interesting because you're going to notice your mortgage value is a little bit skew. Okay, and this doesn't include your own home. Let me just be clear. Okay, your own home, if you add it in, it actually gives you a better compound effect, but I'm going to exclude that for now because I want you to understand the value of what we're just about to do. Okay, so the mortgages on this will equate to 750K. Okay, you're at this point, nice and simple. Obviously, you've got your deposits. Okay, and then the amount of money you've got invested is 150K. Okay, bear that in mind, 150K, not 250, because the extra is your extra equity. In 10 years' time, the portfolio is worth 2 million, mortgage is still worth 750K. Okay, your money's still worth 150K. In 20 years' time, portfolio is worth 4 million, mortgage is still 750. Okay, investment still 150K. Which means if you had to sell off at that point, you'd end up with a 3.1 million pound profit. Okay, now the beauty about that 3.1 million pound profit is it all started with 150,000 pounds starting money. That's what you started with, 150,000 pounds, okay, from an equity release. And not only that, you've been paid an extra 1,875 pound every single month for the entire 20 years. Well, in actuality, that will go up because rents continue to go up. Okay, whereas your mortgage will stay the same. Hopefully, you're all sitting there going, that is beyond outstanding. And I can keep going and going and going and going with this stuff because this is, property is beyond amazing. Okay, it is absolutely fantastic. Please write this down and please understand property is not get rich quick. 10 years and 20 years. We're not talking 1 year, 2 years, okay? 10 years, 20 years. Property is get rich for sure. This is your future wealth plan. And when you've built this portfolio, you are not selling the portfolio for this profit, although it's there in equity. Okay, what you're going to end up doing is paying off these mortgages. And this is where you leave this as a legacy so that your family can then continue to earn income for the rest of their lives and continue to be taken care of financially for the rest of their lives. Okay, this is a long-term wealth plan. Okay, this is the stuff that we teach in our 3-day trainings, like how to be able to create your long-term wealth plan for you and your family. Okay, wonderful. Now, I mean, that pretty much covers everything I wanted to cover there. Now, I've got a couple of exercises for you guys to be able to take away from this session. I mean, I'll actually list these down quickly. So the first thing I want you to do is I want you to think of how much funds you can pull together within a 12-month period. Okay, funds, total funds. So that's, you know, if you're selling out, you know, stocks and bonds or, you know, whatever you have, okay, and releasing as much money as possible to be able to pull into a bank. Now, I understand you're not going to do it in one lump sum. You're going to do it in phases. But I want you to think about how much money you'd be able to pull in, all in within a 12-month period. Okay, equity release, raising money through friends and family, like wherever, as much money as you think you can pull in within 12 months. Okay, then what I want you to do is I want you to figure out how many properties you can buy with that. Please understand a typical buy-to-let, your money left in around £15,000. So how many buy-to-lets can you buy with that money? Okay, that's the next thing. How many buy-to-lets can you buy with that money? Okay, then what you're going to do is you're going to figure out what the cash flow is for that portfolio. Okay, what is the income every single month for that portfolio? And then what is the income every year? And that's where you sit there and go, holy shit, this is actually pretty impressive. Okay, and then I want you to figure out what can you do with that money that you cannot do with where you are right now in your life. So what difference would that money make in your life? That income, not the capital, not the cash, okay, the cash flows, the income that comes in every single month. What could you do with that money? How would that change your life? Okay, that's kind of where I want to take you guys today. That was the whole session. And I want you guys to really think about, you know, is it now time for somebody, or is it now time for you to change something in your life to start to be able to create a future plan, a wealth plan? Because if you're honest with yourself, the vast majority of you will be paying down your mortgage. And at some point, yeah, sure, your house property will go up, okay, and your mortgage will be down. But all you're going to be doing is limiting the amount of equity you can gain. And therefore, when the time comes that you have to downsize and use that money for other stuff, etc., is that really enough for you and your family to survive forever? Okay, or is that going to be just enough for you to survive, hopefully never having to worry about covering the costs of a home, etc.? Question, please ask questions away. We're literally, this is it, we're in the Q&A time. The last 20 or so minutes is Q&A. Ask whatever questions you guys have. Please feel free to ask them. Get them down in the chat. And obviously, we're on YouTube. We're also on Facebook Live. So any questions you have, please make sure you drop it in. I can't see how many people are actually viewing at the minute. Unfortunately, it doesn't tell me. But I am very curious as to the Facebook Live. Kevin, does it tell you on your Facebook stream? If you can log in. Okay, so what's your view on the market as a result of the current climate? Best time ever. I can't. All my money's in True Bells. That'll grow too. You'll be fine. It's all good, Gavin. It's all good. Okay, sweet. Okay, so in terms of the market conditions, so we actually did a video on this. If you take a look on our YouTube channel, also on the Katana Property Channel on the Facebook group, you'll be able to scroll back. Episode 1, we actually did a whole thing on Corona. Really good question, Bounce. Essentially, my belief around this is we are primed for the biggest bounce back in history to date, in market history to date. So, I mean, understand, I mean, I don't know how much you know about economics, macroeconomics, etc. But within the UK economy, the government's pumping in £450 billion. When money gets put into the economy only needs so much money to operate, and it operates with the same amount of money. And the extra money that goes in via the economy and gets used, all that ends up happening with that is that moves into investments of some sort or savings of some sort, which is equally an investment. So either would go into property, it would go into stocks and shares. I'm a doctor of it. Oh, dude, beautiful. So then this makes this very easy. So my belief personally is, you know, if you have this amount of money pumping into the economy, it has to go somewhere. Okay, that's the first thing. Second thing is the government's just reduced the Bank of England base rate, so the LIBOR. They've dropped it down from 0.75% to 0.25% to 0.1%. So by dropping it to that level, what they're also doing is they're massively incentivizing people to invest in property. So exactly the same as what you saw with Brexit, where they said, oh, it's the Brexit recession and all that sort of stuff. All you saw was a pause in the market where everybody was waiting for essentially things to become more secure so they could get back into the market. Literally, the minute Boris announced that the Brexit was happening and the date that it was happening, you saw a very, very strong bounce back in the UK economy. You saw the house prices in London from going down for 20 months in a row. They started to pick up. The house prices in the north of England started, instead of picking up a little bit, started really booming. We noticed a massive uptrend of the number of people we're competing against to invest in property. People start buying houses for more money than they should. Gazumping starting to come back in. So you started to see a big upspike in the turn of the investment market. Now, all that Corona has done, okay, because bear in mind, we're on a very strong up curve. All that Corona has done is basically created that uncertainty again, basically paused the market. And I know people are still buying property now, although they're all struggling because of banks and lenders. But as soon as that stops, I can't see how the market would do anything but for go up. I mean, potentially you'll have a minor downturn for a very short space of time while everyone sort of feels out the market and figures out if it's the right time. But I mean, with the amount of extra money in the economy and the incentives to be buying, I can't see how it could not like really snap back really hard. But yeah, hopefully that answers your question. And you being a doctor of economics, just so you know, I think that's super cool. I had no idea. It's the things you learn about your mates. So yeah, so hopefully that sort of ties in with your understandings as well. But I mean, that's, and I've consulted with a lot of very high level people with regards to this, you know, very high level bankers and other economists and stuff. And it's interesting because I see some property people all, oh, it's the next recession and all this stuff. And you see a lot of the media doing this. And I hate media hype because, as you all know, the media can create a self-fulfilling prophecy where if they say something enough, the rest of the country starts to believe them, you know, Corona included. So for me, my belief is providing the media doesn't create that circumstance for us, I think we're good. But it's, I mean, I don't have a crystal ball. I'm not, you know, I'm not God. I can't foretell the future, but you know, it's cool. And it's a pleasure. I absolutely love answering questions. Right. Okay. Has anybody else got any other questions on what we're doing ahead of us wrapping up? Obviously we've got a bit of time, so I've allotted time. As soon as we're out of questions, I'm more than happy to wrap up the session and make it a shorter session. I don't mind. I've got some recording to do tonight anyway. But if you have any questions, especially if you're catching this on recording, please feel free to answer your questions within the chat, whether it's on YouTube or whether it's on the Facebook Live. Please feel free to drop it into the chat. I'm more than happy to answer any questions you have within there. There's somebody always monitoring the chat. Inclusive, what I'd love you guys to do, if you're on YouTube, please subscribe to the channel. It helps the feed to continue to grow. If you're on Facebook, please join the Katana Property Channel group or the Katana Group Limited page. We've got a lot of cool stuff happening on there. We're running live training, so I think we've got a live 3-day training again where we deep dive into all of this stuff, as well as how you can actually do this and implement this within your life, within your portfolio, creating your financial freedom. So we're going to be covering that. I think it's going to be running in about a month's time. If it's something you're interested in, just make sure you're in one of those groups. You'll be hearing stuff about it. Absolutely cool, Barnes. More than happy to chat offline. You know where I am, you know my number. Please feel free to drop me a message. Happy to grab a call. If any of you want to have a bit more of an in-depth chat with me, then do just drop me a message. I'm always open to have a conversation. But it looks like that is the end of the questions, which is awesome. So I'd like to just wrap up by saying thank you very much, each and every single one of you, for taking the time and joining in. Please do share this. I want to continue to give people knowledge about how they can look after their own financial futures. Unfortunately, poverty within the UK is a real thing. A lot of people don't have any or haven't been taught how to have the right financial intellect on how to be able to build their financial futures and look after themselves long term. And I'm making it a mission of ours to start to get that out to people so people can start to understand the value of building a portfolio, the value of looking after their finances, and the value of planning for tomorrow as opposed to just looking after today. So please do share. Please do get this out to your friends. We're going to be running another one next Tuesday at 8 p.m. So we run this every Tuesday at 8 p.m. I have no idea what we're going to be covering on the next episode. I'm sure our marketing team will confirm something ahead of time. If you're not already on our database or pages, please get yourself on. It has been an absolute pleasure to spend the last hour with you guys. I hope you've all had massive value from what we've done. And I look forward to catching up with you guys in a week's time. And I think we might also be doing a brief Facebook Live on Thursday with some market updates as well, which would be pretty cool. So thank you very much, guys. Bye.